Ladies and gentlemen, good morning and a very, very warm welcome to the Nedbank Private Wealth Philanthropy webinar. My name is Nozipho Tshabalala, and it's such an absolute pleasure to be the moderator of today's conversation. Now, the context for our conversation is important. We know that COVID-19 has had a massive impact on already volatile South African markets. But in addition to that, we know that it has eroded value. And this is important and matters a lot for foundations and charitable trusts that depend on investments in the form of dividends, investments from dividends from their own investments, but of course dividends from the investments of others as well. And so in this conversation and in this webinar, we're really going to be exploring the question of what is the impact on long-term sustainability of these foundations and charitable trusts. And perhaps more interestingly as well is what investment decisions should trustees be thinking about and grappling with in the light of this reality that they're having to navigate today. And so I'm really excited for the experience that we're going to be sharing with you today. You're going to hear from the head of philanthropy, Nozipho Tshabalala, who I'll introduce in a moment. But we also have a guest speaker. Her name is Roshini Maharaj. She's a portfolio manager at Nedbank Private Wealth. And she's going to be taking us through an investment presentation that really gives us the canvas against which these complexities have to be managed. And then we're going to make our way into a robust panel discussion where I'm going to be introducing our special guest for that panel discussion a little bit later. But in addition to this, I'd like to perhaps put a challenge to you all, and that is let's have a dialogue, let's have a conversation. And I will remind you ahead of the panel discussion to use the Q&A function to send me through your questions, send me through your comments, and I'll do my best to put those to our panelists today. I've got a few more house rules for us before we get started. So in addition to the Q&A function, if for whatever reason you're experiencing technical issues, especially in the form of your webinar freezing, just go and refresh your link and you will be redirected exactly back to our starting point and where we are in the conversation. And then, of course, we always get questions about the recording and whether this is going to be available afterwards. It certainly is. You're going to be getting an email over the next couple of days with the link to this recording. And so you will be able to watch it over and, of course, enjoy the insights that we're going to be lifting from today's conversation one more time. And so allow me to introduce Nozipho Tshabalala, the head of philanthropy. We know her as one of the most passionate people, not only in South Africa, but on the continent about economic and social development. And straight after Nozipho has given us her opening contextual remarks, we're going to transition into the investment presentation from Roshini. Roshini is responsible for assets under management in excess of 4 billion rand. But most significantly, in terms of today's conversation, a sizable portion of that portfolio that she manages comprises funds that belong to public benefit organizations as well as charitable institutions and foundations. Once Roshini has shared her presentation, she would have laid the ground for us then to go into the panel discussion. And so without further ado, Nozipho, what a pleasure to have you here with us, and over to you to officially open and share some of your thoughts this morning.
Thank you, Nozipho. Good morning, ladies and gentlemen. I'd like to extend a very warm welcome to everyone online on behalf of Nedbank. Thank you for connecting with us this morning. As humans, we are wired to connect and belong. We actively seek connections with others, to ideas, and to places through what we do, how we live, and think. Today, we are here to connect you to a very important conversation, the long-term sustainability of charitable trusts and foundations after COVID-19, looking at the impact on both donor organizations and the effect on nonprofits alike, through input from our expert investment specialists, as well as insights and sharing of ideas by two organizations, the Cape Wine Auction Trust, who provides funding to organizations in the Cape Winelands, and the National Sea Rescue Institute, a non-profit that runs a massive operating budget annually and relies on mobilizing resources in order to carry out their activities. At Nedbank Private Wealth, we make the links and connections between your money decisions, goals, and life's uncertainties more visible, and therefore help you make financial decisions that are aligned with what is important to you and that enable you to achieve your goals and reduce your fears about the future. This is the foundation and the starting point of our advisory approach. We do this because we want to connect you to more ways to help you make better decisions about how you bank, invest, give sustainably and impactfully to the causes you care about. I'm confident you will draw valuable insights and best practice from today's conversation and will join us again in follow-up events as we continue to unpack principles and best practice towards greater sustainability for the philanthropic sector. Thank you.
Thank you, Knox. I take it it's my cue to go. Good morning to everyone attending today. Happy Monday. I will try to not make it a blue Monday and present to you on this very important topic that is really top of mind for a whole host of investors, from retirees to long-term investors, and most importantly to investors like yourselves, the trustees of charitable trusts and foundations. And how is it that we deal with the long-term sustainability of the funds that you've been entrusted with to preserve and grow and to carry on with the immense great work of grant making to those who are most in need. I'm going to be dividing my presentation into two aspects. I'm going to deal with the economic uncertainty and the financial implications of what's happened during the COVID-19 pandemic, and then I will move on into the decisions and the dilemmas facing trustees today in terms of how to maintain that sustainability for their charitable trust portfolios. So just looking at what happened to global economic growth as the world went into lockdown earlier this year, I've put up a chart here of our own GDP growth over time, just demonstrating as a proxy for what really happened throughout the world. Of course, we're all very aware, and I've got the point set out there on the right-hand side, that growth was already in a slowdown mode on our side for some time to come prior to going into lockdown. Unfortunately, and as we all know, March 27th came around when our president announced that we'll be going into a level 5 lockdown, and that brought our economic activity to a complete standstill. Bearing in mind that that is what informs GDP growth, it was no surprise then that when our Q2 GDP figures were released, it was hugely disappointing and reflected a decline of 17% in our economic growth from the first quarter of this year to the second quarter of this year. So very alarming, and a lot of you might have read in the press that we had declined by 51%. So that was just really the annualized effect of that quarterly decline, which nevertheless just highlighted in what serious financial difficulty we were from an economic perspective. Of course, we were not alone in this. It affected every economy around the world. The US economy, being the largest economy of the world, went into a 7% decline in GDP from the first quarter to the second quarter of this year. Just how, did governments and central banks respond to this calamity? Thankfully, they didn't sit on their hands. They were very proactive in their responses and put in a fair amount of monetary and fiscal stimulus into the global economy in order to stave off any kind of protracted recession and us moving into a 1930s type global depression. If we have a look here on this chart, just setting out what happened from a South African perspective, we had our Reserve Bank aggressively cutting interest rates by 3 percentage points this year, with the last cut coming through in May. bringing our repo rate and overall interest rates down to an all-time low. And that was really in an effort to really stimulate economic growth in the country, to not bring things to a standstill, because if interest rates are lower, then you are possibly more inclined to borrow if you are a business or someone requiring debt. And that was very much the principle followed all around the world, where you found most economies, apart from China, cutting interest rates to an all-time low, in some cases almost close to zero. What also followed from a monetary policy perspective was that the Reserve Bank also embarked on a bond purchase program, and to date has purchased close to 36 billion rand in government bonds. Again, not too dissimilar to what happened across the world with our global counterparts. Once again, just freeing up the capital in the bank's balance sheet and allowing for economies to flow and transact a lot more freely. Governments, of course, were not to be left out and came forward with fiscal stimulus packages. Back home, we had our president announcing a package of 500 billion rand to be put into our economy, partly borrowed from the IMF and partly from reorganizing our budget, and just really putting in that much needed help for the poor, for the unemployed, and for the smaller businesses who were really very distressed during this pandemic. So sadly for us, this lockdown really was the final nail in our investment grade rating, and in between worrying about our health concerns and going into lockdown and worrying about the health of our investments and portfolios, we then had Moody's, being the last ratings agency, that also then decided to downgrade government debt to junk status. That also happened in March, which really painted a very bleak economic picture for us going forward. Thankfully, a lot of the stimulus that was put both here as well as globally did have the desired impact of us managing to stave off a depressed type situation from an economic activity perspective, and we are starting to see signs of an economic recovery coming through. Early indications of third quarter GDP stats being reported around the world, especially from China, are starting to show that economies are slowly recovering, and that the stimulus did have that desired impact in terms of containing the uncertainty that was afflicted upon us at the first quarter of this year. Of course, and as you know, we live in an interconnected world, so all of this economic uncertainty will impact capital markets and in particular equity markets. And what I've set out here is a chart of our own market, the Johannesburg Stock Exchange, showing you the JSE and what happened if you have a look at the extreme right-hand side of that chart, where you see the big dip that happened in our market in March this year. So at some point, our market, together with all other global equity markets, were down about 30% year to date. We closed the first quarter off down 20%, which really was a miserable blow dealt to all investment portfolios of our clients, and in particular those of charitable trusts and foundations. So I've got a very well-known proverb set out here on the right. The best time to plant a tree was 20 years ago. The second best time is now. And that just really holds true when you think about capital markets and you think about volatility in the time of a crisis and in the time of uncertainty. You can see this chart takes back the performance of the JSE over a very long period of time. And some of the more recent economic and financial crises we've endured was the Asian crisis of 1987. We had the dot-com bubble, for those of you who may remember, in the early 2000s. And of course, the most recent crisis that we all talk about is the great global financial crisis of 2008 and 2009. what's very notable from all of these crises is that we do see that after that initial sell-off and shock and risk of sentiment that comes into equity markets, the recovery does eventually come through. Takes a bit of time, but it does come through. So our messaging to our clients was very clear, and it was to please not panic, to not react with emotion, to try your best not to knee-jerk as hard as it might be, and to remain invested for the long term. And that just really, on the economic and market aspect, is to accept that markets will be volatile during times of uncertainty. We are facing one of the biggest health pandemics ever in our lifetimes, and please may this be the last, certainly in our lifetimes. The second wave is causing a lot of jitters, and there's talk that the president might announce more restrictive lockdown measures when he talks to us this Thursday. And I think we just need to accept that until a vaccine is introduced that is going to contain the spread of this virus, that uncertainty will continue to linger. On the positive side, I think we must take comfort from the fact that governments and central banks, both here and around the world, are very proactive in responding to crises like this and are very ready to put in the necessary measures in order to keep the global economy moving forward. And we've also seen that coming through from our own government and our central bank. We will have to wait and see that the early signs and the green shoots coming through from a recovery in the global economy. We need to ensure that that's going to be sustainable going forward, but the signs are there and they're encouraging. And I think we need to be realistic that our own economy is going to take just that little bit longer to recover because of the pre-existing challenges that we had in not having sufficient economic growth going into this lockdown. And then finally, just a flag, especially for those portfolios that have a large amount invested in cash or are invested 100% in cash, just please be aware that we are in a very low inflation environment here in South Africa and also offshore. And that, that is informing very low interest rates right now, which will have an impact on the sustainability of your portfolio's capital and income requirements. Just moving on now onto the important investment decisions that you as trustees need to make about your capital and income sustainability. And really here, what I wanted to start out talking about is how we build portfolios for our clients. And the building blocks we use are all the different asset classes that are at our disposal. And what I've done on the left-hand side is set out the performance of these building blocks, of these asset classes over a long period of time. So this tracks the 20-year performance of the different asset classes up until the end of September this year. These are the real returns, so inflation of about 5% has been stripped out of this performance. And what you can see is that having been invested in the JSE and in listed property shares has really served portfolios extremely well and did perform and provide trustees with great returns over that period, even better than global equities, believe it or not. There were good real returns to be had out of local bonds and cash, but not nearly as dramatic as what you would have gotten from being invested in our stock market and in our listed property shares. So just taking that same picture of these same building blocks and having a look at how they performed over a shorter time frame. So this is over a 5-year annualized period, and suddenly and sadly, the picture has changed quite dramatically. We can see that the real returns out of the JSE have all but evaporated. Listed property, unfortunately, has turned negative, and global equities has suddenly come out as being the standout asset class to provide long-term capital growth. There were still real returns to be had out of bonds and cash, but you can see quite a lot lower relative to what you could derive from global equities. And I just want to again touch on cash returns for those portfolios that have a lot invested in cash, to please be aware that on the longer term, cash gave you a real return, but was really quite a lot lower than all of the other asset classes. And in the short term, now this return will be further diminished by virtue of the lower interest rate environment that we're in. So the questions we've been fielding from trustees and our clients is really, why even bother investing in the JSE? Let's just invest offshore, because this is a complete disappointment. And I can't blame you for having that view, because we can see what's happened over the short term in terms of the returns out of the JSE. I'd say, just having a look at how our market is constructed, that perhaps we shouldn't abandon in being invested in the JSE altogether. What's very evident is, if we have to look at how the earnings of the 40 largest companies listed on the JSE are derived, it's quite insightful to note that they derive more than half of their earnings outside South Africa. So that just really talks to the quote here, that in reality, the South African equity market mirrors less of the heartbeat of our sadly slowing South African economy, and rather reflects what is going on in the rest of the world. So just bear that in mind, that by investing in the JSE, you're not necessarily only exposing yourself to the South African economy, but also be mindful that our market is a very concentrated one. And what I've set out in the chart on the right is what makes up the largest part of our market. And these are 5 shares that make up our entire market, and the same 5 shares making up a very commonly used index, the shareholders weighted index, the SWIX index. And you can see that 5 companies constitute between 40 and 50% of our market, making it very concentrated exposures. You don't necessarily want to be invested in excess of 20% in Naspers and 10% in BHP, etc. So the guidance is not to run away from the JSE, but to maybe consider taking investment advice in terms of which stocks to include in your charitable trust portfolio. On the offshore side, and I understand that it is not a comfortable discussion to have. We all South Africans, we all loyal to the country of our birth, and the charities and the foundations being run here are for the benefit of South Africans. So we want to be invested in South African asset classes. I think if we just look and see how markets have evolved and changed over time, and have a look at how the size of our market has reduced from 1998 to date in terms of the number of companies listed on the JSE, and just look at the size of the JSE relative to global equity markets, obviously matching the size of our GDP relative to global GDP, one cannot shy away from the discussion that you need to embrace a little bit of offshore exposure into your portfolio for a charitable trust and a foundation. And just this pie chart on the right really showing you how the American market really dominates and makes up over half of global equity markets. The next largest market, Japan, at less than 10%, with the UK, Germany, and France all very small in single digits. So just very important to be aware of shifting themes and not to completely shy away from having some sort of offshore exposure in your portfolios. Listed property stocks. So this has long been a favored asset class of trustees because of the regular and growing income you could derive from this particular asset class. Think of all the owners of shopping centers and office parks and industrial properties. Their rents go up every year, which means in turn their distributions go up every year. And it just was a lovely formula that worked in terms of getting that growing and recurring income stream coming into portfolios, and that could be used for grant making purposes. Unfortunately, with the slowdown in our economy, coupled with the lockdown that we sustained this year, it has sent this asset class down 50% year to date. And what happened is that we find that the dividend yield of the listed property sector is now almost twice that of our 10-year bond rate, really just, as we're saying, indicating that there are quite a few issues with this particular sector, and one needs to be very cautious and careful as to how we navigate and invest in listed property shares. I set out some research we did on the largest listed property company, Growth Point, just indicating how its loan to value is slowly creeping up relative to its debt covenant levels because of the drop in its market value, and how its rental collections were impacted by the lockdown, although it's starting to show signs of recovery. And really, because of that impact on its income, it obviously doesn't have as much to distribute for this year. So we're not saying don't invest in listed property, but again, definitely an asset class you need to navigate with an extreme amount of caution and not to depend on too much for your source of income for grant-making purposes. So I'm rapidly running out of options here to give you as to what to invest in. Looking at cash, and I've been mentioning this a few times now, and you can see here on the left-hand side, cash rates, the purple dots showing you that cash rates are at an all-time low all over the world, not excluding ourselves at 3.5% repo rate, definitely on the lower side of what our interest rate band has been over time. So that then has far-reaching implications for portfolios that have a lot invested in cash, because this time last year you were earning close to 8% per annum out of a money market or core income type fund. This year you are lucky if you are getting close to 4.5% per annum out of the same fund. So just be very mindful of that. Together with inflation averaging at about 3.1%, cash is not necessarily the asset class you want to be overexposed to at this current stage. And of course, just demonstrating across the world, if you're sitting with interest rates at or close to zero, you are going to be facing the very real possibility of negative yielding debt. So bonds, a topic that a lot of trustees prefer to stay away from, and I don't blame you. I fully understand we are junk bonds. Our bond rates are extremely high. We can see that on the left-hand side by virtue of being downgraded to junk, by virtue of foreigners selling out of our bond market. There's a high degree of concern of the default coming through by government, and you know it's preferred for us not to be invested in this particular asset class. As an investment manager, what I can point out to you is that the yield being offered by bonds is very attractive. We've just set out here the yield out of cash from October last year to October this year. You can see the decline. You can see the increase in the yields you're getting out of bonds. The yield differential between bonds and cash very much favoring an investment in bonds. And what we've been doing quite nicely for a lot of portfolios of charitable trusts and foundations is adding 2 or 3 bonds that have different interest distribution dates. And what that does then is it just brings in that income certainty into your portfolio, that you know on these dates you are going to be getting X number of rands flowing into your portfolio from the bond interest. So what about a default, you ask? Yes, so that risk is definitely there. Can't run away from it. We discuss bonds all the time in our investment committee meetings. Currently, we are of the view that for our government to default on our bonds, it would really take a move that they have then decided to put the government employees' pension fund at risk, all private sector pension funds, our entire banking system at risk. We really feel that that is quite an unthinkable scenario, and we'd like to believe that government is not really wanting to take that particular path Obviously, we're keeping a very close watch on this asset class for any further signs of deterioration. But for now, and as far as securing regular, repetitive, predictable, high income, it is an asset class you should not ignore. So finally, just taking all of those asset classes I spoke to and putting them all together, what I've set out here in this table is that for each of these asset classes, they have different characteristics when it comes to income, capital growth, and volatility, risk. How much does their capital fluctuate by? And that's also just set out in the table on the bottom left, where cash, by way of example, has the lowest risk in terms of capital volatility. It pays you a regular income. Unfortunately, your return and your capital growth is very low. On the far end of the spectrum, you take equity or shares, which are very risky. They're sitting very high on the risk end of the table, but your returns are equally high. And yes, you do get an income stream out of being invested in equities from dividends, but as I said there, depends, because we've noticed this year, as a result of the COVID pandemic and as a result of the economic uncertainty, that we have had a few companies passing up dividends, which again puts pressure on portfolios. So once again, just try and get that predictable income stream going with bonds. And then giving you an example, it's always good to see all of this at work. So I've set out a portfolio that we manage and have been managing for many years. It started out in 1998 with close on to 20 million being invested. And at that stage, it generated annual income of R1 million. Fast-track the market value and capital growth, the sustainability of this portfolio. It's now worth about 120 million rand, and it has managed to grow its income stream to 4.5 million rand per annum. So just really taking in all the principles of asset allocation. There's the international exposure for long-term capital growth, the SA equity, selective JSE shares put in there, not too much in property because of the structural challenges the sector is facing, bonds to secure that regular income stream, and of course you need a bit of cash for liquidity. So just echoing the words at the bottom there, that the difference between success and failure is not which stock or which piece of real estate property you buy. It really does come down to effective and active asset allocation. And my final slide, and this really is as we wait a vaccine and a confirmed treatment for this pandemic that has really dominated our lives this year. Please remember, this is not the first crisis we've had, nor will it be our last. I sincerely hope it's the last in my lifetime, but it won't be the last. Just please be mindful that investing 100% in cash may not be a sustainable outcome for your portfolios from a capital growth and an income stream perspective. Please exercise caution. Listed property, that asset class is structurally disrupted and will require a fair amount of intervention in order to recover going forward. Do not disregard our beloved JSE. Selective investing in conjunction with an active manager will yield you good results. Become a global investment citizen. The world is changing. There's so many global themes. Everything we do, from the smartphones we use, from the medication we take, to the search engines we use, to our online shopping, all of it comes through in some shape or form from a company that's listed on a global market. Try to embrace bonds as part of your portfolio to secure a regular and a predictable income stream. And just really, from what I've experienced in my career, and advice combined with an actively managed investment solution can result in long-term sustainable outcomes with charitable trusts and foundations. Thank you.
Roshini, thank you very much for an incredible overview of the investment landscape as you know it. And without a doubt, the insights that you've lifted for us in this conversation are going to create the perfect backdrop for the conversation that we're going to go into. So it's my pleasure now to welcome Raymond Ndlovu, who's on your screen right now. As Nokolo indicated, Raymond is the Group CEO of Community Investment Ventures Holding. He's also the chairperson of the Cape Wine Auction Trust. And so we're really pleased that you're with us, Raymond. We're also joined by Dr. Cleeve Robertson. Cleeve, lovely to have you. Cleeve, of course, is the CEO of the National Sea Rescue Institute of South Africa. And they raise more than 150 million rand in donor funding each year to sustain their services. So I'm sure that Roshini's, landscape and canvas painting was very interesting for the both of you. Now, as we go into the panel, I'd like to just remind our audience again that Q&A function, the chat is there for you so that we can integrate your voice into the conversation. So, Robbins, I've already seen your fantastic question that I'm going to try and pull in. We'll circle back to Roshini towards the end of this panel discussion just to hear her voice again on what she's heard. But, Cleeve, let me come to you first. In light of the anticipated slowdown in funding over the next couple of years, what measures is your organization taking and putting in place in order to adapt and to sustain its operations and its fundraising approach rather at this time?
Yeah, good morning, and thanks very much for the opportunity to share some of our experiences over this terrible time. Simon, I think you have to take a very long-term view of systems development within a non-profit company. And I think we've been gradually building systems to avert, any form of disaster. I mean, I think we're an emergency service, so perhaps we used to crises, more than others. But from an operational point of view, we were able to deliver all our services through COVID. In fact, everybody expected a downturn in requests for assistance, but in fact, there was an upkick, particularly in relation to medical evacuations from ships at sea. So we had to sustain, normal ops during this entire period, which we were able to do. A big part of that, however, is training and our education, both of whom suffered, except, with the right innovation and flexibility, and the IT systems already in place, we were able to develop and deliver training seminars, webinars like this, online to our 50 stations across the whole country. And our educators were particularly innovative, got on the radio in terms of delivering water safety information. So, they, through innovation and just, involvement, they were able to convey messages all over the place. Fundraising, March really, I think, took everybody by surprise. And you'll be familiar with our two competitions, the debit order competition and our CARP competition, and both of those are run through a call center. So you can imagine with COVID having to take a call center virtual within a space of a week. But again, if you've done your homework and if you have the preparation, we were able to take that call center virtual with offsite applications within a very short period of time. And yes, you lose some of your effort. We were down to about 30% of our usual effort. But, in a crisis, you start and then you build slowly. So that's what we did. Parallel to that, obviously, you just cut all your expenditure. So all our capital projects were canned immediately. You pull back on all the operational expenditure that you can. But again, in a very short period of time, within a month, we were able to put those capital programs back online and start building boats and doing the things that we did. So if you've got a long-term kind of view of the world in terms of, your systems, and you react quickly and flexibly, you can survive a crisis like this.
So, Cleeve, that's a fantastic response. And what I'm hearing you talking about is, sustainability from the get-go, that being the core approach. You're talking about innovation that lends itself to agility, and you're talking about the courage to, pull back and preserve the core when it is necessary, but also the courage to go back and reinstate certain projects at the right time. Raymond, I'm keen to get a sense of how that has played out for you and the extent to which the trustees of CWA had to review their support for education in the context of the current environment. But I've got a second part of this question, Raymond, for you to think about. How important has it been for trustees to have a really good handle on the world of investments, especially if they are, responsible for the oversight of assets and investments for the trust?
Thank you very much for that question, Nozipho. As with every organization globally, we have had to really look at what's the model that's supporting the foundation, and more importantly, is our strategy fit for purpose, given the change in the radical change, the reset economically and financially. And we are a donor-driven organization, as with everyone, but the difference is that we only have one annual event that enables us to raise the capital that we require, albeit we've been successful over the last 7 years, but a lot of that has been driven by foreign donors, international donors, who use the opportunity to be here in South Africa to enjoy the Cape Wine auction itself, and then through that event, we then raise the capital. So first and foremost, that's been removed. Going forward in 2021, we've had to be looking at different ways of raising capital, because we can't have an event with 250 or more odd people in attendance. We've also had to give a lot of consideration to how much of the money that we do raise has to go to immediate requirements, because education is about the child and the teaching environment. It's not just about delivery of books and classrooms. And so you have to consider the welfare of the people that you're educating. So we've had to kind of diversify the focus of where we're spending our money, including feeding schemes, nutrition, and the like, to alleviate the immediate humanitarian, crisis that came along with COVID-19. So it's been devastating. Yeah.
So I'm hearing a number of things here, Raymond, that in addition to having to rethink, review, refresh on the strategy, the central question being, are we still fit for purpose? And we often talk about diversifying revenue streams. And what I'm hearing you saying is we had to diversify our mandate and begin to think beyond the core of what we believed we existed for. Absolutely fascinating. Cleeve, I want to come to you with something that is a little bit difficult, because I want to talk about the accumulation of healthy reserves that we know, take many, many years for those reserves to be accumulated. And oftentimes they are set aside for investing in capacity and investing in growth of the organization. But we know that when crisis hits, it oftentimes doesn't give us forewarning that it's on its way. And one of the places that trustees will turn to is, of course, the reserves. Quick question to you is, have you had to tap into your reserves at this time? And if you have, what are the guiding principles that have ensured that the executive team and the trustees are really managing these reserves in such a way that they can be accessed because they need it, but hopefully can be replenished when we make our way out of what you both have described as terrible times?
No, thanks very much. So in 1994, National Sea Rescue really was in a very tight space. And I think that memory of vulnerability lives on in the organization. So over 20 years, we've managed to create a reserve fund. And about 8 years ago, they created an independent endowment trust for us. And any excess or surplus cash is invested in that. And then within that structure, there we have, I think now 5 portfolio managers across 5 different houses, and they're given a broad mandate or guideline, and they invest those funds on our behalf. The plan in the long term is not to draw down on that fund and to maintain it as a reserve unless you have an immediate huge capital or emergency requirement. So during this crisis, we haven't drawn down on our reserves at all. We just shut down everything and tried to survive within what we had, and we've been able to do that. So, I mean, that's the long-term plan. But the structure to that is, there's a board committee that deals with investments. There's a separate group of trustees that make those investment decisions and meet with those portfolio managers, and together they work out what the best strategy is for investment in the market at the current time. And you've already alluded to the difficulties in the current market. But I think the other thing that we miss is that you have to invest in your own business at the same time. So you have to invest in systems that will secure your future.
Yeah. And that's the point I want to bring you on in, Raymond, this idea that Cleeve has raised about this complexity of, having to balance the fact that you are still having to invest in the systems and the processes so that you do have the capability. And you mentioned earlier that you had to sort of begin to diversify your mandate. And I suppose the question to you is, how difficult was it to strike that balance? On the one hand, responding to the immediate needs that the community is demanding, but on the other hand, having a firm eye on long-term sustainability, on organizational effectiveness, on systems and processes that allow you to actually carry out that mandate.
In short, it's been with great difficulty, but thankfully I'm supported by a very capable group of trustees with a variety of skills across many disciplines, including investments and finance. That's also my background, so that helps in the sense that the first thing you want to do is make sure that you preserve capital, because the reserves are no longer reserves in as much as they continue to dwindle. So that's the first thing, is protect the downside. And listening very carefully to Roshini, I related a lot on what she was saying about how the last few months, the change in financial and economic circumstances globally and locally has meant that one has to keep a close eye on how are you going to do that first. Mm-hmm. Secondly, we needed to make sure that we continue to be sustained in our operational expenses from the returns on the reserves as opposed to the reserves themselves. And that takes some deft movement. You've got to be clear about what you're using to cope with the current crisis. And also, most importantly, as Cleeve says, living within your means is critical. So we had to go with a fine-tooth comb as trustees and really look at what was necessary and what was nice to have. And we actually reduced our costs quite drastically. We changed the way we're doing things. And I think it's been good. Insofar as it's been a crisis, we've tried not to waste it. We've tried to say, how do we actually make sure that we reinvent the model such that we can, on the one hand, continue to generate income on a more sustainable basis from different sources and in a more innovative way. But on the other hand, that we can actually operate on a much better footing that will ensure that as we grow that nest egg of reserves, we're doing it on a smaller cost base for the long term.
And so with that, Raymond, I want to introduce to the both of you the conversation around resilience, because I think ultimately, the ability to be innovative in how we attract more funding, the ability to be innovative in terms of fundraising activities, the ability to lean out our operations and expand at the right time, all of that comes back to the central point of resilience, because foundations and charitable trusts that have survived and will survive this crisis will be the ones that have demonstrated the higher resilience. And I think the inverse is also true. And maybe, Cleeve, first to you, what have been the biggest lessons you have learned about resilience during this time, and lessons that I'm sure our audience would be keen to maybe even apply within their own context?
Thanks. I think it's a long-term view in the world, and you have to build those systems every day towards the future to be able to resist any challenges that are going to come, and COVID's been one of those. I think your fundraising model in this context is central to that, and Raymond's also alluded to the need for diversity. And fundraising doesn't happen in isolation. Your fundraising, marketing, and communication strategies need to be really well aligned, and they need to be time specific. So, what's good for today isn't good for tomorrow, and you need to adapt your strategy going forward. You need to be on a number of social media platforms. You need, we've got a magazine out there, you've got a website, you got all the, and you're talking to different communities of people of different age groups through all of those different media. So that stakeholder communication is central to your fundraising effort. We have a huge diverse range of fundraising activities, from trusts and foundations, the normal events and the kind of usual charity things, to our competitions, which are really large competitions. But then the risk is also spread over 100,000 different donors. I mean, we have probably in excess of 3,000 corporate donors and 90,000 individual donors. So you spread your risk across a huge group of people. And I think, if you look at the biggest charities in this country, they collect very small amounts of money from a large group of people. And I think that's the lesson, is the days that Vodacom or a big corporate gave you 20 million rand for an asset, those days are gone. And you have to realize that. I think the other thing is that state capture and corruption have eroded our dependence on state-owned entities and government. And we can't depend even on the lottery anymore. You can't depend on funds. So you have to spread your risk across a range of activities to secure your future.
Sure. Cleeve, as you're speaking, I was scribbling notes here because I think this is absolute wisdom. So build systems daily. So systems aren't these things we build every decade or every 5 years. It's a daily, everyday investment into your systems. It's about thinking long-term and in long-term horizons, about diverse fundraising. And what I loved about what you shared about the significance of keeping conversation and connection alive with your stakeholders and communicating across a range of platforms. And as I come to you, Raymond, I want to lift a comment. Actually, it's a question, but I'm going to position it as a comment that has come through from our audience. And Robbins is saying, has our personal confidence to give recovered? Because ultimately, I think, as you're saying, Cleeve, it comes back to many individuals giving a little bit. To what extent are we able to resuscitate, if you will, the confidence to give at a personal level and a connection with that crisis to say, this is when I'm most needed to step up? So beautiful commentary there. So Raymond, let me come to you. As you think about your lessons around resilience, what would those be, and what should other nonprofits be paying attention to as they try to build their muscle of resilience as well?
I think first and foremost, one's got to bring the context of what the impact of COVID-19 and any other crisis for that matter back home, to ask firstly the people with whom we are expecting, through whom we're expecting to deliver this change. Are they okay? Because this is done with and through people. And secondly, we've always had an ecosystem approach to doing things. The Cape Wine Auction Trust has always positioned itself as an enabler of other organizations. And so what we've then done is to build this community of education specialist organizations who in themselves have got their own global community of donors. So what we've then done is to lean on each other to say, times are tough for all of us. How do we start to leverage our common skills and contacts? Because it is a community after all. And to the extent that we have had to deal with the immediate concerns of feeding the kids and the like, we then turn to those people who've got the expertise in that regard, in nutrition and well-being, and they help us to tap further funding so that it's no longer each person fishing for themselves. Let's go all get the big net and catch the big whale, as it were, as opposed to all trying to fish separately. So resilience is about community. It's about collaboration, as much as it's about also making sure that you are keeping the capacity to deliver as inspired and as motivated as possible.
Sure. Fantastic. So, Roshini, I'm going to be coming to you in a second for your thoughts as we close off this conversation. But I do want to just quickly lift what you've said, Raymond, that ultimately this is an opportunity for us to all build towards one net and catch a whale instead of, fishing separately. I love your contribution around ecosystems, leveraging off each other's strengths, but ecosystems where we become enablers and enlargers of each other. I think it's such an incredible insight in this regard. So, Roshini, I want to bring your comment here. You started us off with a fantastic canvas. What we've had here is some very real examples of response and of navigating this complexity. As you close us off, what are some of the big things that you think would be important for trustees and executives of foundations and charitable trusts to be thinking of to maximize in terms of, you know, not surviving this time, but certainly thriving through it as well?
Yeah, thank you, Nozipho. I think for me, it's very important to understand and appreciate as a trustee that you're not alone, that there is a lot of investment advice and support available out there to help you navigate a very, very challenging time. Most importantly, to not react emotionally to what's happening around you. We simply can't control what's happening around us. Economic uncertainty, market volatility, these are factors outside our control. But what we can control is the funds that we are custodians of, and how we protect those funds, how we grow those funds, and how we get and anchor ourselves to a recurring and predictable income stream. And I think I would encourage trustees to remain focused on those objectives and to not be shy from seeking advice and guidance from wealth managers and portfolio managers who will help you navigate very, very challenging times. We don't know all the answers, but we can certainly work together and map out a solution that best fits your specific objectives.
Roshini, I think that's a beautiful way of closing it. I'd like to extend a special thank you to yourself, to Raymond, to Cleeve for sharing their experiences with us. Ladies and gentlemen, as we close off, a quick reminder that you will be getting an email in the next couple of days. So this recording will be available for you. There's so much richness in the contributions that I'm sure that you're going to want to tap back into that. Also, if you want to access any of our previous webinars, any of our thought leadership, and even future recordings, please just check out our website. And you will have all the details there. We look forward to continuing having these important conversations with you. Last but not least, we really value your feedback. It gives us an opportunity to up our game and make sure that each and every webinar is better than the last. So if you could kindly please complete the survey that will be sent to you for us so that we could do that. So from myself, Nozipho Tshabalala, and on behalf of the Nedbank Private Wealth team and Nedbank, thank you very much for making the time to join us, and I hope you enjoy your day further. From me, it's goodbye.